our final panel before lunch is going to be focusing on managing risk and reward in the frontier markets. So I'd like to introduce the moderator for the final panel before lunch, Kamran Bajwa, who's a partner and head of the Middle East practice for Kirkland and Ellis. Please give a big round of applause to the final panel before lunch, Kamran and his team. Thank you.
Hello, everyone. Please, panelists. Great to be with you, and I'm personally excited to be with three trailblazers and global experts in investing in frontier markets. It should be a very informative discussion. What I'd like to do is, with the opening question, offer the opportunity to each of our panelists to talk about what you do, what is your basic background in your firm in frontier markets, but more importantly, what attracted you to frontier markets? How did you end up being an investor in frontier markets, and why are you focused in that space? So we'll start closest from me and work down. Alison Graham, founder and chief investment officer of Voltan Capital Management. Could you tell us a little bit about yourself and Voltan and why you're in frontier markets?
Yeah, sure. So Voltan is, we trade equity and debt in public markets across the frontier. So we don't do any kind of mainstream emerging markets. We're specifically focused kind of off the EM index. I've been doing that since the early 90s in whatever constituted frontier markets at the time. So when I started in finance, Mexico was a frontier market, and we kind of followed the whole development of Latin America from frontier to mainstream. In the mid 90s, I moved to Russia when that was the next frontier market, and spent about 7-8 years in Russia until that became again mainstream. And since 2008, we've been running Voltan Frontier Markets Fund, which trades, again, equity and debt globally in about 50 or 60 countries in the frontier markets. The main thesis is that we're not doing kind of following an index or looking for large cap liquid stocks. We tend to do more kind of structural anomalies, mid to small cap stocks, other types of securities where we can find some type of unique value. In terms of why I got into frontiers, I think I'm not sure I would have any competitive edge in trading kind of liquid U.S. markets. I think there are people smarter than me that can do that, but I grew up in frontier markets, and I think just having a bit of background in kind of how things work in developing countries gives you a bit of an advantage.
Wonderful, thank you. Tim Collins, founder of Ripplewood Holdings, global investor, very much so in emerging markets and frontier markets. Could you talk about your background and again, why frontier markets?
I thought Jassim was going to talk about my background. Okay. Well, I'm jet lagged, and I had our Christmas party last night, so whatever I say, you have to take with a grain of salt. My background is, when I was 17, I ground crankshafts for Cummins engine, and then I went to university and studied philosophy and went back to Cummins engine. I got to wear a shirt and tie, which I thought was a big deal now. I sort of outgrew that. Best job I've ever had. So I've spent the remainder of my career trying to find a way to recreate what was a truly amazing personal and professional experience working in Columbus, Indiana for a company that made diesel engines, which is not everybody's fantasy. So what we've done for 25 years, originally we had a series of private equity funds which we invested all over the place in all kinds of different businesses. Some of you probably know we're pioneer investors in Japan. We bought the 5th largest bank in Japan and lots of other businesses. We've invested in Egypt in that private equity fund. And then about 6 or 7 years ago, a partner and I decided that we wanted to change the model. And so now what we do is much more concentrated much more high conviction investing and in things that we think we can create value over a longer period of time. So we had a private equity world, we had a gross IRR of 54%, but a 3.5-year holding period. So we decided we would much rather use our time to create a 19% IRR over a 10-year period. That would be much more rewarding and much less brain damage. So that's what we do. We have a business here in the region that is a company in the DIFC that's made investments in Saudi and Egypt. We have a bank in the Baltics, which we're moving to Paris to expand its footprint in other smaller markets. And all of those things are things that we want to build and add value to and own, a decade from now. Hopefully we will. Jassim's going to tell the rest of my story.
Absolutely.
Yeah. So Jassim Seddiqi, great to have you with us as well, CEO of the Abu Dhabi Financial Group. Could you talk to us? Of course, you're based here in a region which is a hub for frontier markets and emerging markets. And again, could you not only tell us about Abu Dhabi Financial Group, but what your interest is and how you think about frontier markets?
So I'll complete the introduction of Tim after my part. So my background is electrical engineering, and engineers like to solve problems and like complicated things. So when we started ADFG, we've always wanted to be opportunistic and create value by solving problems. So because our backyard is really an emerging market, we have a big focus on the UAE and the GCC as an emerging market or a frontier market. There's a debate there. So Tim, a good friend, he calls emerging markets or frontier markets complicated markets. So we focus on complicated markets and complicated opportunities, and we drive value from there. This is what we do. This is our forte, and we've been doing that for the past 10 years in ADFG, not shying away from complicated investments and opportunities, and we've done great, thankfully, over the past 10 years. And we will continue to do that in the GCC mostly, but also in other markets like Egypt and Eastern Europe.
So Jassim, if we could stay with you for a moment. When we talk about, at a very broad level, opportunity in frontier markets, the kind of standard initial thought is, well, we're markets and opportunities where you have higher risk, you have higher reward, okay? Is it that simple when you think about your markets, or are investors missing some nuance in the fact that there are ways to get into these markets that may not be as high risk as perceived?
Mm-hmm. I think risk is a very subjective term. You know, if we look at the opportunities that are available today or were available in the past, in the region at least, in emerging markets, the risk reward is very much comparable to global opportunities, but the reward is really what makes the difference. If you can understand how to protect the risk, protect your underlying, and you have a management that can turn around opportunities, I think the risk part of it is exaggerated. We've seen great returns, great rewards over the past 20 years in emerging markets that completely outweigh those in developed markets. Not to say that developed markets, the opportunities are not there, but it's just how comfortable one is or a team is with opportunities in specific jurisdictions. Mm-hmm. So how I like to see emerging markets is what is happening or what has happened in developed market. Emerging markets will eventually converge to that. So I'll give you a very good example on secondaries. So in 2010, we started the first secondary private equity fund that buys secondary LP positions of Middle Eastern funds. It was the first of a kind in the region, but it was very much a popular strategy in developed markets. So we are not shy of copying with pride what has been successful in different parts of the world. And we started this fund, and it did really well in the past 10 years. So when you see other opportunities like pipe investments, taking a stake in public companies and turning them around, something that Tim does very well. Maybe he tells us about his recent investments in Saudi and Egypt and public markets. But we've also proved that fallen angels, companies that have failed in the region, public companies can be turned around and go back to heaven again. So we've done that with many companies, most notably GFH Financial Group out of Bahrain, Shua Capital out of Dubai, and many more. Those are on the public equity side. So again, risk is a very subjective terminology, really. I think it all depends on the team, on the leadership of how one tackles those opportunities, whether they are in developed markets, emerging markets, or frontier markets. Investments in general are complicated, so that's why you need experts to handle those.
Thank you. Yeah, and I think what you're saying about it ends up being about the company is really important as well. There's a lot of talk that goes on at a high level, macro, theoretical, but ultimately
Absolutely.
you're talking about looking at the company, the management, that exact sector. So Tim, just sticking with this theme, you are an investor that has experience with some of the world's most developed, largest markets like Japan. And you talked about France now and what you're doing there with the bank, but also some of the more emerging and frontier markets. So can you abstract from that and talk about thematic differences in risk and reward, or is it also just all about the individual opportunity when you look at investing across regions?
No, it's not about the individual opportunity at the exclusion of the environment. I think if 5 years ago you could say, I'm investing or I'm building a business and I don't really want to worry about the politics. You were sadly educated to the contrary in recent, wherever, UK, US, Japan, this part of the world. So our approach, as Jassim said, is we don't think about the sort of traditional buckets of frontier, emerging, developed, whatever. We're looking for environments where we can make businesses thrive. And I'd say there are 2 or 3 things about this that I think are important. One, we want to be in environments where the governance and level of transparency is getting better, not worse. I mean, I'll give you an example. I shouldn't use this word, but we were offered what on paper was an incredible opportunity in the Ukraine, went there 6 times, met Poroshenko 3 or 4 and said, there is no chance that we're going to invest in Ukraine, but we have a wildly successful investment in Latvia, where all of my friends in the States said, there are Russian tanks on the border. And we said, well, there are Russian tanks on the border, but there are kids from southern Georgia on the other side, southern Georgia, United States. There are American troops on the other side. There's Article 5 of the NATO Convention. They're in the Euro. They're in the EU. So, it just doesn't feel like there are going to be Russian tanks in Riga. And we were right. It's been a wildly successful investment that we're going to expand, quadruple over the next 2 or 3 years. So it's the environment, and then it is the opportunity. What we're doing in France is in a big developed market, but it's guerrilla warfare. We're going to put a very small team there with ultimately unlimited access to capital, and they're going to be disruptive as long as they can make a 15% ROE. They can't make a 15% ROE, then they can't be disruptive anymore. So it's really, the environment is really important. Politics, turns out, are really important. We invested in 2004 in Egypt, exited 9 months before the revolution, not necessarily related, but I was there all through the revolution. We've invested again in Egypt. That bank, the Commercial International Bank of Egypt, 2004 had a $600-700 million market cap. It's gone through 2 revolutions and now has, I think, a $5.5-6 billion market cap. So, you know, it's some complicated set of factors that you finally work your way through all the gates to get to the point where it's for us an investment opportunity.
Wonderful. And if we have time, maybe we'll come back to exploring political risk. What I think is fascinating is over the last decades, we always thought about political risk as only applying to frontier markets or emerging markets. And as you said very well, whether it's the US and trade policy with China or Brexit in the UK, the largest economies and most stable countries are also experiencing a lot of political risk when it comes to the business environment. Alison, so you are someone that really has a broad exposure to true frontier markets, and you talked about Cambodia, Vietnam, and other markets like that. So right now, there's a sentiment around the world that the developed economies are experiencing slow growth. I mean, that's borne out by the facts. Low interest rate environment. People aren't sure what that really means yet, but they're cautious. And how do you find frontier markets? Is it an opportunity to go back to environments that have higher rates, higher growth?
Yeah, no, that's actually specifically a question that a lot of investors have been asking us lately in the context of what I guess is now called the Japanification of the Western world. Again, you know, low rates, low growth, low productivity growth, and low inflation, a kind of environment that becomes very difficult to break out of. And whether that happens, you know, next year in the US or the year after or 5 years, I think it's definitely coming at some point. Also, as many panelists mentioned, 17 trillion in negative interest rate securities, and a lot that are kind of 2% or less. So we've had a lot of interest from investors saying, are frontiers kind of the next 20 to 30 years theme that they should be looking at? We have, you know, I was just in Cambodia last week. The economy is growing at 8% per year. You know, Vietnam just revised its measurement of GDP, and they found out the economy was 25% larger than they knew based on old measurements. So the two objections to this tend to be, number one, that a lot of frontier countries are exporters. And so if you look at something like Zambia, can it continue to thrive if its basic product is copper, and copper is dependent on housing construction in US and China? This is objection number one. And number two is simply that liquidity in frontier markets is too low. So it might be the source of a lot of growth, but it doesn't matter if you can't actually access it. The counter arguments I would make is that, first of all, what we actually see in frontier markets, most of the countries where we invest, they're not being driven by exports. They're not being driven by kind of global commodities. They're being driven by just domestic changes that create tremendous value. And this can be things like just, you know, ease of doing business, ease of starting a company, better electricity supply. That's a huge one in the markets where we trade. You know, increase in domestic demand. So a lot of the companies we invest in are just they're selling domestically. They're not dependent on what's going on in China or the US. And on the issue of liquidity, I would say two things. One is that we don't do a lot of private equity, but you know, our colleagues do. And I think actually the main trend in frontier markets is going to be on the private side. So there you're not dependent on liquidity in the markets. And the second thing is that, to me, liquidity is a little bit fictional. And by this I mean that a lot of investment has gone into emerging markets these days based on the fact that, say, EM debt is liquid. Well, we know that that can vanish instantly. the opposite is also true, that liquidity kind of begets liquidity, and the more people that become interested in frontiers and buy the thesis of growth, the more liquidity develops. And I think given the kind of size and breadth of the economies that we're looking at, that is something we're going to see in the next 5 to 10 years.
Wonderful. Tim, if we could try for a moment and pull the curtains back a bit on the actual investment process. What I'd like to hear you speak about is quantifying some of these risks and factors we talk about. When we look at valuation in a more frontier emerging market, what are you doing in that process? Of course, I imagine you're starting with market comparables, which are going to be
We're not.
less. Okay.
No, we're not.
Talk to us about your metrics on how you come up with a valuation, and then what I'm curious about is when you look at the risks, whether they're political or operational or other things, lack of liquidity, for example, for an exit. What are you doing? Are you putting a judgment call on a discount to valuation, or do you have more of a data-driven process for that?
It's binary for us. Let me say one thing, just parenthetically. The world lost one of the great public servants, of our lifetime, Paul Volcker, this week. He was a truly remarkable man, a selfless public servant, and he worked with us starting in '98 on these financial institution investments. And if you want to know the acid test for what risk you're willing to take is would somebody with that reputation be prepared to put their reputation on the line to do what we want to do. And we don't quantify. We have a really simple model. We don't quantify some discount rate based on some perceived volatility or beta in the market. That's a fantasy. We basically want to get a 20% return over a decade, and we want to get it without regard to market fluctuations. So in banks in particular, we look at if we get a high teens return on equity, then it ought to trade at 1.5, 2 times book. It's that simple. So the question is, can we get sustainably a high teens return on equity? It is the political analysis is profound and important, and we work with people like Kathy Ashton, John Kerry to give us advice. We go to these. We don't ever invest until we go over and over and over again and meet with people on all sides of public life and business people and students and everything else. So it's being preoccupied with that, and we have a second layer, and that is we don't want to do anything. When I restarted the business, we made 3 rules with my partner. 1, we don't do anything with anybody we don't like. So if we don't have dinner with someone, then they can't work with us, invest with us, be a lawyer for us, nothing. 2, we don't do anything just for money if it isn't interesting and important, which is why Paul, I think, was always comfortable doing stuff with us. If it isn't interesting and important, then it's just not worth our time. And then there is a certain quantum of money that we have to be, expect to make in order to allocate time to it. But when you have the second principle, and that is, I'm not doing something unless there is a value to that environment, and that was clearly not obvious at the time, but clearly the case when we bought the long-term credit bank. We probably saved the Japanese financial institutions from a massive collapse, and a global who knows what. That is your best insulation. And what that means is you have to have a willing partner on the other side. Not necessarily the government per se, but the environment has to be one where you can actually do what you want to do to create that value, both financially and as a byproduct to the community. And that's a really simplifying. It's a really simplifying thing. If we can't, we just don't invest.
That's great. No, thank you for sharing that. And it's really a ground-up, comprehensive, multipolar approach that I'm hearing from you. And that's a lot of food for thought. Jassim, in the closing minutes here, it would be great to hear from you maybe about a specific investment that surprised you in the last few years. What's an investment that comes to your mind that beat your expectations and really to you kind of reassures and convinces you of why you're in this emerging and frontier market sector?
So a very good example, and it's a very popular one in the GCC, is GFH Financial Group. This is one of the earliest Islamic investment banks in the region. In 2015, and by end of 2015, it was on the verge of collapse. So it's, it did not have the right liquidity. It just came back from a debt restructuring, and it had a lot of issues with its funds. So it had issues with the investors they had. So we opportunistically, at that time, when oil prices were almost $30 a barrel, we took a stake in the business and we actively got involved in the business. Today, this company is the leading investment bank in the region. It's as profitable as the most profitable investment bank in the region, publicly listed. And it really, over the past 4 years, compensated its old investors monetarily and otherwise. So this is an example of a company in an emerging market that has failed its shareholders, investors, regulators, the public, everyone. But with the right management and the right ideas and the persistence and the belief in this opportunity and in the environment, it became a champion today. Not only did it add value to the ecosystem, but today it could be a story to attract more investment to the region. So that is one of our most successful investments today.
Thank you. Jassim Seddiqi, Tim Collins, Alison Graham, thank you very much for a wonderful panel, highly informative, and personally, if we had more time, would have loved to continue the discussion, and hopefully you'll get a chance to do that with the audience and other members. Thank you.
Thank you very much.